Hey everybody, this is Jim at SP500chart.com. It's 4:15 on March 5th, 2013, and the markets are closed, and we're going to take a look at the S&P 500 as we do after virtually every day's close. And as we do before every video, I read this to you. That www.sp500chart.com and this video are for educational purposes only. Nothing stated at the side or in the video is intended to be used as investment advice. I can draw lines on charts, but you have to draw your own conclusions from your own research and make investment decisions that are suitable for your personal financial situation. That's a mouthful. And, most importantly, I don't want to misrepresent who I am or what I do. I am not a licensed financial professional. I am just a guy who draws lines on charts. Well, today we got a breakout above our small inverted head and shoulders pattern, had a neckline at about 1525, and as the market is so fond of doing, it seems, it likes to just gap up over this line, making it essentially a very difficult thing to play unless you were just willing to risk it and think, well, yeah, I think it goes up. So we ended the day yesterday right at that resistance level, the neckline of the pattern, and we gap up. Not only do we gap up, we spend almost, not quite, but almost all of the day above, but just barely above, this lower resistance line that it's, well, I say resistance, this lower line that should now serve as resistance that used to be support in the channel that we saw working for all of 2013 until the breakdown in well, not exactly the last week of February, but late February. So we're coming up in this channel right here, these two red lines. We fall down, we make an inverted head and shoulders, which serves as a continuation pattern. And you might remember that I drew kind of a little bit of a parallel between this pattern and what we saw in 2010. However, I want to remind you, in 2010, we were looking at things that were taking place over a much larger time frame. And as a matter of fact, heck, excuse me, I'll just show you. Here you go. This was what took place in 2010. The inverted head and shoulders pattern took nearly 4 months to complete. This pattern that we've been looking at has taken, what, about 8 days. So big difference in the time frame, and frankly, big difference in the targets. If I recall, that 2010 pattern had a target that was going to, I believe it was to result in a, well, what the heck? Let's go back and take a look at it again, rather than make me try to remember. Yeah, this had a target of roughly 100 points. So that's a lot better than the little pattern that we're looking at here that has a target of about, I think we said 40. Was that it? Let me measure it. Yep, about 40. Hey, but that's not too bad, really. The problem is that this pattern is up higher in the S&P, which means a technically significant breakout at this level has to make a larger move in number of points than what that pattern did in 2010. Because in 2010 we were in around the 1200 range. Now we're up around 1500. So where the number of points is about the same, the percentages is different. So in other words, 100 points back around 1200 would result in roughly an 8% move. We are now looking at something less than 2%. That said, I've put two new lines on the chart that may pan out. We'll see. This lower one here has 3 touches, and I'll go through my methodology with you very clearly. I saw that we had 3 points that lined up. So the next thing I do is I take this line and I create a parallel line, and then I say let's move it to where I know we have 2 touches back here in late February, and we extend it on up, and lo and behold, it lines up with where we started meeting resistance today. So that tells me this line may be worth keeping on the map. And here's my thinking too. We gapped up over 1525. I think that's a good thing. It's a bad thing in the sense that it pretty much meant you had to place your bets before the market opened this morning. But I think it's a good thing because now I think we have a better chance of maybe having a portion of a day or maybe a one-day sell-off to bring us back down to hopefully this level. If that's the case, then I think a very short-term long position may not be a bad idea. Now, for one thing, we've seen that the S&P has shown it can at least attack this line and get over it. So if we come back down to this level and then head back up, I think that this market may have the strength and the gumption, the steam, whatever, to get back over this line again. So I would say I would put my trust in this inverted head and shoulders pattern that has a target now of right at, call it 1560. I think that should do it. So if we come back down to 1528 or so, with 1560 in mind, that's still a 32-point move. You're looking at roughly a 2% target. That seems more attractive to me today than what I was thinking yesterday. But only if we come back down. If we go sideways for a while, then I'm not thinking it's worth playing for that extra 20 points. But I think it's worth playing for 30, 32, or 33. That's me personally. So guys, let's see if we have now a new channel that we can use going forward. Again, this red one worked for a long time. Then we made this continuation pattern, and I remind you again. When channels break, it is for one of two reasons. It is either to set up a reversal or to set up a pattern that serves as a continuation. And frankly, breaking bullish channels that go sideways, often that's kind of the definition of a bull flag. So you might say this is something of a bull flag. It's not exactly the right shape, but we had about 2 weeks of sideways. Now it looks like we're going back up. So looking at tomorrow, I would love to see a quick little pullback to the 1520s, and then a bounce. And let's go ahead and get up to 1560. See if that target gets met. And I remind you, that is a minimum target. Now, finally, the last thing I want to say is this. The headlines are now saying stocks hit all-time highs. Well, that's not altogether true. The S&P has not hit an all-time high. The NASDAQ certainly has not hit an all-time high. The Dow has hit an all-time high. But we've looked at these long-term charts before, and we've seen where the Dow's got more room to do so. The S&P chart doesn't show the same amount of headroom that the Dow Industrials has. And I think we took a look at that a little while back. Maybe we'll take a look at it again. But what all this to say, when it seems like it's clear sailing and when everybody now starts to get on board, when, quote, Joe Retail starts plowing money back into the markets, that's time to be very careful and to be very watchful. So, and again, I mentioned a while back, we do not have any kind of pattern up here presently that says we are at a major top. We really don't even have a pattern that says we're at an intermediate top. We're just reaching levels where we would expect a top to likely form. And one of those levels is this brown line. We're now clearly above that line. But you see that we did that back in 2011 too, only to end up suffering what was a really pretty precipitous fall. So let's keep our eyes on it. This red line up here around 1600 is also worth keeping an eye on, because that is something, well, I don't have to go to a monthly chart. Let's go to a 9-day, see if we get it. There we go. There you go. That line, if it's touched, would be an all-time high for the S&P 500. But that doesn't mean that the S&P 500 is out of the woods, because I would expect this line to present a challenge. Now, if we get there, we've got some things to look at. We're not there yet, so I'll save that for a later day. But for right now, let's see if we get a little pullback tomorrow. If we get a pullback to the mid-low 1520s, I would, well, even if it's later in the day, even the mid-high 1520s, that might be a good spot for a short-term long position. So guys, thanks for watching the video. Thanks for your support, for your subscription. If you're seeing this on a Tuesday afternoon, if you're not, if you're seeing this and you're thinking to yourself, gee, I wish I'd seen that earlier in the week, come on over to sp500chart.com. For less than a cheap cup of coffee per day, you get these videos on the day that they're produced after each day's market close. So look, guys, thanks for watching. Take care.